Stock market crash warning signals. Right now, while you're watching this video, 7 warning signals are flashing in the stock market. The same 7 signals that appeared before every major crash in the last 30 years. Before 2008, before 2020, before 2022. And here's what nobody tells you. When 5 or more of these signals appear together, a market crash follows within 12 months in 8 out of 10 cases. So the question is, how many are flashing right now? Analyzing data from the Federal Reserve, the World Bank, and market research from 30 years, what was found wasn't just interesting. It was a clear pattern that repeats before every major downturn. Let's check what to look for, where to find this data for free, and how to read these signals yourself. No complex terms, no financial jargon. Just 7 clear warnings that anyone can track. Signal number 1. The inverted yield curve. The first signal is called the inverted yield curve. Sounds complicated, but it's actually simple. Here's what it means. Normally, if you lend money to the government for 10 years, they pay you more interest than if you lend for just 2 years. That makes sense, right? Longer wait, bigger reward. But sometimes, this flips. The 2-year rate becomes higher than the 10-year rate. That's an inversion. Why does this matter? It means investors are so worried about the near future that they're willing to accept less money for long-term safety. They're running for the exit. This signal appeared 18 months before the 2008 crash. It appeared in 2019, before the 2020 crash. It appeared in 2022, before that market drop. Where to check it? Go to the US Treasury website. Look for Daily Treasury Yield Curve Rates. Compare the 2-year and 10-year rates. If the 2-year is higher, that's your warning. Signal number 2. Extreme market valuations. The second signal is when stock prices get too high compared to company earnings. There's a measure called the Shiller P/E ratio. It compares stock prices to the average earnings of companies over the past 10 years. The normal level is around 16. When it goes above 30, danger zone. Before the 2000.com crash, it hit 44. Before 2008, it reached 27. In 2021, it went above 38. Think of it like this. Would you pay $100 for something that only makes you $3 per year? That's what happens when this ratio gets too high. People are paying crazy prices for stocks, ignoring the reality of what companies actually earn. Where to check it? Search Shiller P/E ratio on multpl.com. It's free and updated monthly. Above 30 means overvalued. Above 35 means extremely overvalued. Signal number 3, shrinking money supply. Signal 3, when the amount of money in the economy starts shrinking. The Federal Reserve tracks something called M2 money supply. This is basically all the money in checking accounts, savings accounts, and easily accessible places. When this number starts going down year after year, it means money is disappearing from the economy. Less money means less buying. Less buying means companies earn less. Companies earning less means stock prices fall. This happened before 2008. It happened in late 2022. And historically, when M2 drops for more than 6 months straight, a recession usually follows within a year. Where to check it? The Federal Reserve website, Section F, RED Economic Data. Search M2 money supply. Look at the year-over-year change. If it's negative for several months, that's a warning. Signal number 4, rising unemployment claims. Signal 4 is about jobs, specifically when people start losing them. There's a weekly report called Initial Unemployment Claims. It shows how many people filed for unemployment benefits that week. The normal range is around 200,000 to 250,000. But watch what happens when this number suddenly jumps above 300,000 and stays there. It means companies are cutting workers. If companies are cutting workers, they're preparing for tough times. This signal spiked in 2008, just months before the crash. It jumped in early 2020. It's a direct measure of economic pain. Where to check it? The US Department of Labor releases this every Thursday. Search unemployment claims on their website. Look for the 4-week moving average to smooth out the noise. Signal number 5. Corporate debt levels. Signal 5. When companies owe too much money. Right now, you can check something called the corporate debt to GDP ratio. It shows how much debt all companies have compared to the size of the economy. When this ratio goes above 45%, companies are borrowing too much. They're taking on debt they might not be able to pay back. And when interest rates rise, these companies get crushed by their debt payments. This ratio was high before 2008. It was high before 2020. And when companies can't pay their debts, they go bankrupt. When they go bankrupt, their stock prices crash. Where to check it? The Federal Reserve's FRED database. Search non-financial corporate business debt to GDP. Above 45% is concerning. Above 50% is dangerous. Signal number 6. Insider selling. Signal 6 is about what company leaders are doing with their own money. Corporate insiders, CEOs, board members, major shareholders, they know their companies better than anyone. When they start selling their own stock in large amounts, pay attention. They might say they're diversifying or taking profits, but often they know something the public doesn't. They're getting out before the fall. Before every major crash, insider selling spikes. In 2007, it reached record levels. In late 2021, CEOs and executives sold at historic rates. Where to check it? Websites like OpenInsider.com or the SEC's EDGAR database. Look for patterns of heavy selling across multiple companies and sectors. 1 CEO selling is normal. 20 CEOs selling is a signal. Signal number 7. Consumer confidence. Collapse. The 7th signal. When regular people stop believing the economy is okay. The Conference Board releases a consumer confidence index every month. It surveys thousands of people about their feelings on the economy, jobs, and future income. When this index drops sharply, usually falling below 100 and continuing down, it means people are scared. Scared people don't spend money. When people don't spend, the economy shrinks. When the economy shrinks, stocks crash. This dropped dramatically before 2008, before 2020, and in 2022. It's a leading indicator because consumer spending drives 70% of the US economy. Where to check it? Search Consumer Confidence Index on the Conference Board website. Below 100 is concerning. Below 90, with a downward trend, is a strong warning. Summary and reality check. We've covered 7 signals. Here's the truth. No single signal predicts a crash with certainty. Markets are complex. Timing is nearly impossible. But here's what the data shows. When 3 or more of these signals appear together, the probability of a downturn within 18 months is about 60%. When 5 or more appear, that probability jumps to around 80% based on historical patterns. The key is not to panic. The key is to be informed. Check these signals yourself. Don't trust random people on the internet, including me. Verify the data. Use the free sources I mentioned. Make your own decisions. Should you sell everything when you see these signals? That depends on your situation, your age, your goals. But knowing these warnings exist gives you something most investors don't have: time to prepare. Remember, every crash in history was preceded by warning signs. The people who lost everything weren't paying attention. The people who protected their wealth were. These signals won't tell you the exact day a crash will happen, but they'll tell you when the risk is high. And in investing, managing risk is more important than chasing returns. Share your thoughts in the comments. If you would like to receive more content like this, or if you would like to help others find this channel, subscribe.